and it is day 69 of the Storage 100 series. I am Joe Downs with the Storage Moguls Mastermind, and today we're diving into an interesting decision you sometimes have in commercial real estate finance: fixed versus variable rates. This choice fundamentally shapes your risk profile and your long-term profitability, and it's not just about the lowest number, it's about matching the rate structure to your investment strategy. We need to move past the simple idea that one is always better than the other here. The rate choice depends entirely on your hold period, your risk tolerance, and the current economic climate. So today we'll break down the mechanics of each option so you can make an informed and strategic decision. But first, let's establish a baseline understanding of what a fixed rate truly means for your loan. A fixed rate loan is the definition of financial certainty for a borrower. The core benefit is that your interest rate is locked in for the entire life of the loan. This means your principal and interest payment will never change, providing perfect stability for budgeting. You're completely protected from any sudden or unexpected increases in market interest rates. And the stability comes at a cost, though. The starting rate is typically higher than the variable option. So you're essentially paying a premium for that peace of mind and protection. So then how does this compare to the mechanics of a variable rate loan? In contrast to the fixed rate, a variable rate is directly tied to a market index like SOFR or Prime. This means your rate, and therefore your monthly payment, will fluctuate over time. The major advantage here is the lower starting rate, which can significantly boost your early year cash flow. However, you are accepting the risk that if the underlying index rises, your payments will also increase. So this structure requires a higher degree of financial flexibility and a willingness to manage the payment volatility. Understanding this risk is key to knowing when to use a fixed rate, which we'll cover next. So when does the certainty of a fixed rate make the most sense for your portfolio? Well, if your budget is tight or you need absolute predictability, fixed rate's going to be the clear winner. And this is especially true if you plan on holding the asset for 10 years or more. You want to lock in your cost of capital for the long haul and eliminate interest rate risk. If rates are currently low by historical standards, you should absolutely lock them in now. Don't pass up the chance to secure a low rate for decades to come. But there are specific scenarios where accepting rate risk can actually be beneficial. If you plan to sell or refinance the property within 5 years, the variable rate's low starting cost is pretty compelling. You save money up front and avoid paying the premium for long-term rate protection that you didn't need. This strategy is best suited for investors who have ample cash reserves to absorb potential payment increases. You're essentially betting that rates will remain stable or maybe even drop during your short hold period. It's a short-term strategy focused on maximizing early cash flow and initial returns. Okay, now we need to cover a critical tool that mitigates the risk of variable rates, and that's the rate cap. The rate cap is your ultimate protection against runaway interest costs. The annual cap limits how much your rate can increase in any single year. And this prevents sudden, catastrophic payment spikes that could cripple your cash flow. The lifetime cap is the absolute ceiling. That's the highest rate you will ever pay over the loan's life. Always treat the lifetime cap as the worst case scenario when modeling your returns. If a lender won't clearly state the caps, you should probably walk away from that deal or the lender. The rate caps are the critical safety net that makes variable rate loans viable for investors. But what if you want both? Well, the low starting rate without the immediate full variable risk? Well, there's a blended approach as well. For many investors, the ideal solution isn't pure fixed or pure variable. It's a hybrid loan that blends the two. This blended approach gives you the best of both worlds: initial stability and long-term flexibility. A hybrid loan starts with a fixed rate for a set period, usually 5 or 7 years. This provides early certainty and protection during the critical stabilization phase of your asset. After the fixed period, the loan converts to a variable rate loan for the remaining term. So you benefit from a lower starting rate than a pure fixed loan, boosting early cash flow. This structure is perfect for investors with a medium-term strategy planning to sell or refinance before the variable rate kicks in. And it balances the need for cash flow protection with the desire for cost savings. All right, now let's put some real numbers to these concepts and see the actual cost difference. Because it's easy to talk about rates in the abstract, but we need to see the real world impact on your monthly budget. So this example shows the significant cash flow difference between fixed and variable rates on a $900,000 loan. The fixed rate at 6% gives you certainty, but costs $57.97 a month. The variable rate starts much lower at 4.5%, dropping the payment to $45.64. That difference translates to nearly $15,000 a year in savings in the first year alone. But this is where the risk really hits. If the variable rate spikes to 8%, your payment jumps to $6,600. That's a $2,000 increase from your starting payment and nearly $800 more than the fixed rate option you could have had. So you have to be prepared for the worst case scenario when choosing a variable rate, because the decision between fixed and variable financing boils down to a simple trade-off. It's a choice between certainty and potential savings. Fixed rates offer certainty and predictability, but you pay a higher cost for that peace of mind. Variable rates offer the potential for significant savings and a better early cash flow. However, that savings comes with the higher risk of future payment spikes. So your final choice must be based on two things: your planned hold period and your personal risk tolerance. If you plan to hold the asset for a long time, certainty often wins out. If you have a short horizon and a high risk tolerance, variable can be a powerful tool. The key is to model the worst case scenario and ensure your cash flow can handle it. Okay, I'm actually glad we were able to get to covering fixed versus variable rates, because the options don't get discussed enough, and a lot of investors forget that the variable is a tool in the toolbox. If you're looking to learn how to buy self-storage, by the way, and or want to join our community, launching very soon, reach out to discuss our investor network at thestoragemoguls.com. That's thestoragemoguls.com, and join the announcement list. Next up, day 70, loan terms decoded, why 25 years or 10 years matters. So subscribe if you haven't already to stay ahead of the curve on the daily drops of these videos, as well as the lives we do every 2 weeks or so. And the next one is going to be awesome, because I'm going to have Ann Mino from Live Oak Bank, which is the #1 SBA lender for self-storage loans in the country. You don't want to miss that one. You should probably watch all of the videos, at least in this section, so you can be on that. Tuesday night, I believe it's the 17th, you can be on with Ann and ask her any questions. She is an expert in the subject and phenomenal at answering your questions. And it's going to be exciting. Like this video if you found the rate cap discussion helpful. And please share this with your network on the social media of your choice to help make them smarter financing decisions. And remember to promote yourself. The more you share, the more you tell people you're in this business. They will thank you later, and you'll thank me.